Darwin German Real Estate is excited to present its next great investment opportunity. Frankford Station is a beautifully stunning, 4-story, newly constructed property just opened in 2020 and provides DGRE partners with an opportunity to acquire a 204-unit, state-of-the-art, A-plus apartment community. Frankford Station is conveniently located adjacent to Interstate 35, Highway 121, and George Bush Tollway, right next door to Indian Creek Golf Course in Carrollton, Texas. Frankford Station amenities include fully integrated smart home controls for lighting, temperature, and door access, built-in enterprise-grade Wi-Fi, covered parking, garages and storage units available for lease, manicured landscaping, doggy park and indoor doggy wash, on-site leasing office and business center, and a resort-style swimming pool with community gathering areas. Frankford Station has 140 one-bedroom units ranging from 638 to 704 square feet, and 64 two-bedroom units ranging from 974 to 1,257 square feet. Frankford Station presents a very unique opportunity of a brand new property with a value upside. The upside is that Frankford Station is only 40% leased, but Darcorp Management will be managing for almost 2 full months prior to ownership, which will allow for leasing at an accelerated rate. As with all DGRE properties, significant tax benefits may be achieved through accelerated depreciation. The Dallas-Fort Worth area remains in the number 1 position in terms of absorption and demand. After a slow start in 2020, demand came roaring back later in the year, yielding over 20,000 apartments absorbed in 2020 alone. That was the top demand performance in the country, exceeding the Atlanta metro area by almost 20%. Since 2010, the North Texas occupied apartment count has climbed by a stunning 201,000 units. During the last 11 years, the DFW area has absorbed the equivalent of every single apartment unit in a metro the size of Charlotte, San Antonio, or Las Vegas. We are excited about adding Frankford Station to the DGRE portfolio and excited about making this investment opportunity available to the family of DGRE partners. Please reach out to the Darwin German Real Estate team to discuss this exciting opportunity.
All right, everybody. Thank you for joining us. I hope you liked that video. Frankford Station Lofts, we had a presentation 2.5 years ago, maybe it was 3 years ago, that Jeremiah Garza came and did because I was involved with, and he came and presented because they were building this property. So what happened is we had a gentleman named Bill that owned the land, and he was contributing that to a new partnership to build the property with Longhorn Capital. And Longhorn brought me in as an apartment guy and for the credibility and background. And in that, when we did that, I was supposed to raise some money. Well, nobody wanted to do new construction at that time. Of course, we have our whole business model, which was, buying value-add properties, and we were making a killing at that part of it. So nobody really wanted to do new construction. So they did this on their own. And I was still a part of the GP interest, a very small part. And then they raised the money, built the property, and it just got completed in September of 2020. So it is brand new, just got finished. And because now they can sell it, and again, they've had a bunch of offers on the property, but that was only after it got leased up. So having the inside scoop with the, being part of the GP interest, we negotiated a purchase price of $37 million for the property, which gave all of their partners a little over a 20% per year average annual return. So new construction made 20% on this particular project, just like I think other ones would at least do that as well. Now, technically, if they were to lease this up and then sell it, my guess is it wouldn't be $37 million. My guess it would be closer to $42 million. So I think we're getting a great deal. So you can consider this a value add play because it is in lease up. Now, we took over, I'm going to scroll through pictures as we're doing it. We took over management of this just 3 weeks ago. And when we took over, occupancy was about 42%. And now, since we've taken over management in just 3 weeks, we've already leased 25 more units. So our occupancy is up 12% in the first month alone, first 3 weeks alone. Now, they still have to move in, so the occupancy isn't really up yet. But next month, you can consider 12 points higher. And I wasn't even budgeting that in my projections, which I'll show you here after we get through all of the pretty pictures. This is part of the clubhouse, beautifully decorated, beautifully designed. Video conference room. They even ran their own dedicated high-speed line direct. They're a internet service provider, is how this works. And we're paying like $9 a unit for 500 megs of internet service. And it's all got all the smart home functions, great workout room. Here's a sample of one of the units. So we make a lot more money on our internet package than we even do on the properties that we're bringing that into. First floor has 12-foot ceilings. Second, third floors have 10-foot ceilings. Big walk-in closets, beautiful countertops, granite countertops, not granite, quartz countertops, beautiful property. One of the partners, Bill, is currently operating Airbnbs out of the units. Leasing was going slow. The management company was horrible. And he said, we need to do something. So he set up some Airbnb units. And he manages those. So he's actually going to be leasing about 20 units back and operating a Airbnb out of the property. So, but he's still paying market rent. So he'll have about 20 of those units. And if he ever wants to get rid of them, we'll just roll them back into the equation. So again, beautiful, beautiful property. A-plus property. Now, the reasons why I like this, it's an A-plus property in North Dallas. It's in Carrollton, just off of Frankford and 35. It's about 200 yards east of I-35 on Frankford. And it's called Frankford Station Lofts because Frankford Station is a huge dart rail intersection right there, where if you want to go downtown, you can just go park right there a couple hundred yards away and take it right downtown or anywhere else you want to go. So that is a major hub, which hasn't helped with COVID hasn't helped because not as many people are riding DART. But for the people that work downtown, they have an easy commute. We also started managing, like I said, on March 8th. So we'll have 2 months behind us before we close. And we're already fixing a lot of the issues. There were a lot of issues. There was actually a few issues, partner issues between the developer and the builder and the contractors, et cetera. But we're fixing all that. There is a builder's warranty. So most things are under warranty. I mean, appliances, air conditioning units, et cetera, are all under warranty. So we'll have very low maintenance costs. Our projected return is 18.4 per year average ROI. And that is with a brand new property with value upside, which is spectacular. And we're looking about 80 cents on the dollar of year one bonus depreciation. Now, assuming that Biden doesn't kill bonus depreciation, we will still do cost segregation, so that will accelerate our depreciation. But if the bonus depreciation is still there, we're looking at about 80 cents on the dollar. So $100,000 investment should get you an $80,000 tax write-off year one, which is absolutely spectacular. Again, this opportunity is awesome. I'll go through the numbers real quick. And of course, you can see the full video on YouTube. You can also get the copy of our investment presentation and our analysis. I'm going to do an abbreviated version of that. Again, here's a picture of Frankford Station Lofts. There is a lighted intersection right there in front of the property, so everybody has to stop there and look at how beautiful our property is. And again, we're the sponsor on this. 1700 West Frankford. We're paying $37 million, which is $181,000 a door. And I think that because of the cost of labor and materials, I think that that is, if that is not below replacement cost, it is real close. Replacement cost actually on this, including the land, was about $156,000. So they are making money on that, but that was with construction costs that are 2 years old. The closing costs of $1,850,000. Now our loan, this is a non-recourse bridge loan. Now it's not all that great of a loan. It is, I'll drop down here, 4.25% interest. It's a 5-year interest only bridge. And there's 2 points going in on the, at 2 points to get the loan and a half a point as an exit fee. So that's why our closing costs are a little bit high. Operating, $400,000 in our operating account. Now, lender reserves. Now, this is different than what a Fannie Mae lender reserve would be. This can be used for negative cash flow on the property, for debt service, for whatever negatives there might be during our lease-up period. Now, that's $900,000. I want you to remember that we have $900,000 in reserves when it comes up later. I have a $31 million loan. So right now we're planning on raising $8,265,000. Now, we actually have a range in our PPM that I think it goes from $8 million to $12 million, I think. And that's because if something comes back on the loan, because they still have to do an appraisal, they still have to do everything, we put that higher number as our max, just in case our loan proceeds are not as high as we anticipate. Now, I'm still confident that we'll be able to get that. Now, also in the PPM, we're showing like an 18.4% ROI. I mess around with these numbers all the time. Right now, it's at 19%, and we'll show you where that came from. Here's our unit mix. All 1 and 2 bedrooms, mainly 1 bedrooms, and 204 units. Our average effective rent right now is $1,378, and we're budgeting $1,462. Now, they are doing concessions right now that are pretty heavy for a lease-up, because of a lease-up, I should say. But it is going to be, we're going to be ratcheting those up as our occupancy gets higher. That'll come into play later. Now, as you saw the roof, it is pitched and TPO, individual electric, individual HVAC, individual hot water heaters. They all have full-size washer dryer connections. It's 4 stories, brick and siding with a slab foundation. Now, nothing in the improvement budget because it doesn't need any improvements. Okay. Here's our performance. Now, current per owner, obviously, with 60% vacancy and collection loss, you can pretty much count these numbers out. Additionally, their property taxes are actually like $400,000 because they haven't had the full markup yet for having a completed property. So we're budgeting much higher once it's closed. So looking at this, this is a 10% vacancy and collection loss. Now, this is as stabilized. However, year 1 is going to be is going to have a much higher vacancy and collection loss number, which you'll see that in just a moment. But we've gone through and done a budget, completed a budget already. Vicki did that. Vicki and Brian handled all that. So we've got our expenses in there, which is a whopping $7,300 per unit. Of course, half of that is property taxes. So we need to do something about that. We all need to gang up and go do something about property taxes because that is just flat ridiculous. But nonetheless, we still have to pay it, cost of doing business, and still our numbers are still good after that. NOI of $1,953,000, company expenses $77,000, $51,000 in reserves, which year 1 we're actually not putting anything in reserves. The bank doesn't require anything to be held back on that, but that's kind of extra expense year 1. Debt service and our cash flow of $469,000 if it were stabilized. Now, obviously, it's not. Debt coverage ratio would be 1.44 and a cap rate of 5.3. So we're buying it with a 0 cap rate because cash flow net operating income is only $92,000. That's because they're 60% vacant. So let's go out and take a look what we're going to do over 5 years. Okay. Collection loss, we plugged in 19% plus a 6% vacancy loss. So 25% vacancy. Now, I want to go ahead and point out something else here. That is income, rental income of $2,684,000. So let's remember that for a moment, for a few minutes. Other income of $220,000. Now, this property has garages, storage units, and covered parking that we all lease out for that other income. So we've got a whole lot of opportunity there, and I think 220 may be low overall, but it's hard to lease storage units and garages, so I didn't want to be too aggressive on that number. So we're actually showing a net income of $1,432,000. Obviously, that's different than what our $1,488,000 is, because I had to put the higher vacancy and collection loss in there. Company expenses, reserves. So we're showing a $39,000 year one loss. Okay. I'm pointing that out because I'm going to show you something in another minute, how this is all going to come together. Now, we'll have it leased up by year 2. So we still have 12% vacancy and collection loss. And that's because we're still going to be burning off concessions. And so it'll be a little bit higher in year 2, but then we can have a pretty consistent 2% collection loss throughout there and a 6% vacancy loss. We're only budgeting 3% on our income increases, just to be a little more conservative. We can always change that. Actually, just for grins, let's change that to 3.5% real quick. And we were at a 19%. If it's 3.5, it goes up to 22.9. So that little half a point extra on income actually makes a pretty big difference. 2% rental increases, and our cash flow, year one, $39,000 loss, then we're making money. Now, we're going to have to refinance this, and I'm planning on a Fannie Mae refi. It's going to be a cash out refi, but very little cash out, $605,000, which is not a lot for a cash out refi of this, but this is budgeting at a $46 million valuation. Now that's in 3 years. And I told you at the very beginning, I think this is a $42 million property. If that cap rate stays about where it is right now, at 4, maybe goes up to 4.2, at a 4.2% cap rate, now we've got proceeds of $4.3 million. So a whole lot more than the 4.7. Okay. So we're not budgeting anything major on a cash out refi, even though I think that could be much higher. Now in year 5, we're budgeting a 4.9% cap. And again, that's almost up a full percentage point. I think that this probably could sell at least at a 4 cap, maybe even a little bit under a 4 cap as stabilized right now. If we're stabilized right now at about a 4 cap, being Class A construction and where it's located. So going up almost a full point over 5 years still keeps us pretty conservative on our exit cap rate, which, by the way, that would be, if you're looking at that, I'm looking at a valuation in 5 years of only $233,000 per unit. I think that's extremely conservative. A 4.5 cap, still a huge difference in valuation, but $233,000 seems pretty low. Now, you know what, I'm going to skip that for now because I told you I wanted to show you this. Being a lease up, we have to do a 12-month budget on what we're doing. So what I did is I did a 12-month budget starting in March when we took over management. Now, 42% occupancy in March is what I'm scheduling. Now I'm budgeting 10 new leases in April. Okay, so that's really, we do 10 leases in March, they move in and they pay rent in April. So really that's only 10 new leases in April. This is huge, huge news. I'm going to tell you right now. Huge. Okay. We've been there less than 3 weeks, and we've already got 25 new leases. 25 new leases in 3 weeks. So huge kudos to Brian and Vicki and the entire team. But my projection was only having 10. May 15, June 20, July 20, the leasing season, June, July, August, I was only budgeting 20. In 3 weeks, we have 25. So I'm probably going to blow this budget completely out of water. Now, March at 42% occupancy, cash flow is negative $113,000. And in April, negative $99,000. Now, we don't own it in those months, so we will not have that negative cash flow. That actually is still part of the seller's negative cash flow during lease up. Now, we will have negative cash flow based on these numbers of $7,849 and $21,000. Now, that will come out of, do you remember the number that the lenders are holding back? $900,000. So that's all going to come out of that $900,000. We're still going to have $750,000 in our reserve account when we refinance this. Now that $750,000 will still be in there. I'm hoping we can get it out earlier than that, based on the cash flow that we're getting. They'll need a debt coverage ratio probably until October, November, and then maybe we can get that out. If not, it's just extra savings account there for us, so that in case we need it for our Fannie Mae refi or any other hiccups, we have plenty of cash there just in case. So we're losing that money. Now, what did I tell you? What did we say I put in down there as a loss for year one? $39,000. Remember that from back here? I was budgeting year one, $39,000 loss. Well, if we go by our budget here, our year one is actually going to be $279,000 in cash flow. So we're actually going to do a lot better than what the projections are when we look at this on a monthly basis. Now, I'm going to point something else out here that I didn't point out. The average rent. I'm budgeting our collections per unit at $1,300. I'm sorry, yeah, $1,300 per unit average rental income until August. So that's sandbagged a bit. And then $1,400, which of course we're going to exceed that as well. So I think I'm ultimately way too conservative on this deal, but because of having more leases than we anticipate and having those leases come in faster, that is absolutely going to help our cash flow, because year one, okay, which actually for us starts right here. So it's this amount here, $279,000. Now, our negative cash flow covered by reserves, $143,000. Our actual cash flow, $422,000. Okay. Now that is all the positive numbers, not the negative. So even though I said $279,000, that negative that's coming out of the account, we don't even have to pay that. That's coming out of our reserve account. So really, our actual cash flow, year one, $422,000. Okay? Now, $422,000 of cash flow when I budgeted zero. I budgeted negative. To the partners, year one, I do have cash flow in there. I put that $422,000 in there for that number, so that can add a more realistic anticipated cash flow. And then we'll still have 756. Now that 756 is not in the numbers at all, so that's additional cash flow. Now, here's what I was showing. The value, if I take the cap rate, make sure I got my calculation here. So if we take our NOI year one, which starts out at 112, that starts off at $38,000, $38,6796, and gets up to our stabilized NOI of $173,000, Our year one NOI is $1.7 million. That means at a 4 cap right now, the property is worth $42 million. Year one stabilized. Now let's take those same numbers. Let's take just the stabilized 173,000. That 173,000 at a 4 cap makes it worth $52 million. Okay. Now that $52 million, that's only $254,000 per unit. So I think that we have the possibility of absolutely killing it on this deal, because even on our cash flow projections right now, which we're going to beat, we've got a $42 million stabilized value. And that's, of course, 4% cap rate. That's what it is about right now, with a $52 million possible valuation at the end of that time. And we are all in on this at, what was our all-in number again? $40 million. So there's possibility of $12 million in valuation with $8.2 million in actual cash required. Okay. If you guys aren't jumping up and down and excited about this, then there's not a single deal you'll like. There are 0 negatives on this thing. We've got great cash flow. We're beating our projections on lease up already. We are going to have an extremely high valuation later on. We do have, like, our refi. When we refi this, that's $605,000 that would be passed on. What if that 605 is not 605? What if we get that $750,000 back with it? So that would actually be $1,300,000, because that's our money that we would for sure get back after refi. Well, now we're over 21%. Okay, just getting that extra money that's already ours accounted for in the overall equation. So this is absolutely killer deal. A $100,000 partner can expect $4,000 in cash flow year 1, $45,000 year 2, $66,000 year 3, plus cash out refi at 5. And because we will have a better loan and the income goes up, now our cash flow is 9.5 and then 10.2 in year 5. I see no reason why we don't have this, maybe even get a better cash out refi and wait until years 5, 6, or 7 and do another refi, do a supplemental, and pull out a whole lot of cash, because a brand new Class A quality property we can easily hold on to for at least 10 years. However, we put in there a 5-year sale and an overall return of 19% per year. Killer, killer, killer deal. Like I said, if you're not excited about this one, there is not a single deal that you will like. So I'm anticipating everybody's in on this. And the only problem is that we're doing this as a 506C, which is accredited investors only. So I apologize for that, but we're using this as a springboard. We're advertising this because we might have to raise as much as $12 million, and we want to advertise this. And we want to advertise this out everywhere. And to advertise this, we have to do it as a C. So accredited investors only. Now, if you don't know what an accredited investor is, then reach out to our team at invest@darwingerman.com. It's not a test or anything else. It's just the qualifications that the IRS uses, or the SEC uses, to determine if you are accredited or not. So, killer numbers, beautiful deal, awesome investment. No reason not to love this one. And as an added possibility is there's a lot next door that is owned by one of the developers, Bill, and he's taking his funds out of this, and he will probably build phase 2, of which I anticipate we will be involved with and manage and lease and probably buy and put together with phase 1 and phase 2 together as one property. So that's another huge opportunity in the future. So that being said, that is the overall presentation for Frankford Station Lofts. And again, killer, killer, killer deal. I'm extremely thrilled about how well this is going to do. And I'll put up the numbers for investors again. Overall, 19% return. So a killer deal. So that's it in a nutshell. So what questions could we possibly have?
Hey, Darwin, let me jump in because I'm going to add some additional exciting news if you don't mind. But before I make any additional announcements, I just want to encourage everyone. This is an open session, so please feel free to type in any questions that you might have in the chat box. We've got our full team here on board to answer any questions that you might have about this exciting opportunity. So go ahead and start your questions, and we'll get to all of them as we go through. But I also want to announce that not only have we got this great presentation, but we are going to host a road trip at Frankford Station this Saturday, the 27th of March, from 10 a.m. to 12 p.m. We'll be there for a couple of hours. Be glad to give everybody a tour, show you this magnificent facility, both inside and out. So please join us. We absolutely will observe social distance rules. So please wear a mask in consideration of all the attendees. But we would love to have you there from 10 a.m. to 12 p.m. Come meet the team, meet the staff, and look at this beautiful property and get any questions answered that you might have as well. So it's an exciting piece of news. So I'm going to go ahead and open it up to questions, and then at the end, for those of you, I see a couple of questions already coming through. Let me just answer this up front. Yes, this webinar is being recorded and will be sent to all of you on Thursday. We'll have an email that's coming out for Thursday that would include the PPM, the video that you watched, as well as all the information here from Darwin's analysis. It'll have everything on it that you need, and we'll have that out. But again, join us at the road trip this Saturday from 10 a.m. to 12 p.m. The address, for those of you who may need it, but we'll send out an invitation as well, is 1700 West Frankford Road in Carrollton, Texas. Again, if you need any of that information, just reach out to us, but we'll have an email invitation that'll go out to everyone tomorrow. So having said that, let's get right to the questions. Darwin, I think you answered this a little bit earlier, but the first question is this on the Dart line? Is this property on the Dart line?
Frankford Station is a large Dart line that's over right at Frankford and 35. So this is a couple hundred yards away from that major rail line.
Okay, I think you answered this one too, but just to reiterate, the question is this available for sophisticated investors?
Unfortunately, it's for accredited investors only. If you've got a question about that, definitely reach out to our team, and they can help you decide if you're accredited or not and how to go about getting that handled.
And will we accept IRA money?
We will accept IRA money. If you're going to do that, though, you definitely need to have your self-directed IRA. You need to get that set up now because funding for this will be the middle of April. So we've only got about 3 weeks. And so if you're going to go set up a new self-directed IRA, you're going to be crunching a lot of time for that. So definitely get on that if you're going to go that route.
This question, Darwin, since you're on the screen anyway, it said, would you please just re-explain how the average investor, what the returns would be over a 5-year period?
Okay, so an average investor, we put in there of $100,000 partner. And what that is your pro rata ownership. $100,000 partner will have 0.97% of the overall ownership. So 0.97 times the cash flow for that year is $4,088. So year one, and again, this would start for about 6 months is when the cash flow actually would start, is 4.1% year one, $4,000. So $100,000 investor can expect $4,000 in year one, $4,500 in year two. And it's possible that we do the refi in year 2 rather than year 3. And if that's the case, then that $6,000 might be in year 2. But again, we'd rather under promise and over deliver. $4,500 in year 2. Year 3, $12,000 with those refinance proceeds. Year 4, $9,500. Year 5, $10,000 in cash flow plus $154,000 in cash back from your overall investment because of the sale. And again, we might want to hold this one longer, but I had to do a 5-year projection just so that we can get the overall return budgeted.
Great. Question, is this Dallas or Denton County? This is Dallas County. Are you counting on any private equity money for this deal?
No private equity money. We'll be able to raise $8.5 to $12 million, I think, pretty easily. This is a spectacular deal.
And we have a comment here that said, are you 19%? Is that real?
That is real. As a matter of fact, I think it's sandbagged a little bit.
Okay, next question. And again, I can take this one as well. Does the current occupancy of 42% include Airbnb units? The answer to that is no, it does not. So if we add those in, that is even more.
Okay, well, let's talk about that for a second. You've done 25 leases this month so far, and those Airbnb units are another about 20 units. So that's 45 units. So that right there adds our occupancy about 22% occupancy on top of the 40% we already have. So we're already going to be at 60% occupancy. We're going to be at 60% occupancy in April, and I only budgeted 47%. So we're already killing it on our occupancy numbers.
Yep. Okay, when do we have to send funds? I may not have funds for another 3 weeks. Will that work?
Middle of April is when we're looking at. We're actually closing at the end of April, and we had some struggles on our last one because we gave a date the funds needed to be in like the day before, and we really had to wire the money to the escrow company about 3 days before. So April 15th is when we're budgeting, needing the cash in, and so that's our target date is April 15th.
Question here, where can we park Saturday? I want to come to the road trip. I'll take that one. If you would, please just park in the back of the property. There's plenty of parking that faces the beautiful lake right across the meadow from the golf course. So if you'll just park at the back of the property so we can continue focusing on successful leasing, I'd appreciate that.
And there's also a vacant lot that's part of our phase 2 that if you feel like parking in the dirt, you can.
Yep. Okay, did you say that this is an 80-20 split between LP and GP?
Yes, it's an 80-20 split. That includes 6% that goes to KPs.
Okay. Next question is, how have you been able to achieve 25 new leases in the last 3 weeks? I guess I'll take that one. I would just attribute it to some increased marketing efforts. As Darwin told you, we've been there. Actually, it'd be 2 weeks and 1 day today. So we took over management on March the 8th. And we certainly utilize all of our resources, whether that be locators, whether that be Facebook marketing. And to be totally honest with you, there was not a lot of marketing going on the property previously. And I would just tell you that we're good leasing closers. So yes, that 25 leases in the last 2.5 weeks is an actual number, and we just expect continued success. Okay, how much per unit? What is the cost per unit? I believe we answered that as 181, right?
Well, we're paying $181,373, but with all the other expenses and operating funds, et cetera, we're going to be all in at $196 a door.
Okay, I'm looking through the rest of the questions. Most of them are the same. Would you please one more time explain the total cash return to a $100,000 partner?
Okay. So what we do is we take our 5-year pro forma and we take all of that and then we put that over because, for example, our cash flow, look at year 2, $469,000 in year 2, right? That goes over here to this side, and that's what the property, this is what the property is going to do. Year 2, $469,000 in cash flow, okay? Now, we times that, we multiply that, because if you're a $100,000 partner, you're only going to own 0.97% of the overall ownership, and that's based on $8,265,000 capital raise. So that number will be a little bit off depending on exactly how much we raise. But right now it's budgeting about 1% of ownership. So you take that times the cash flow of the property. Now that's the ownership percentage you get. So when we do a distribution of the $422,000, which we actually do that monthly, and it's not that amount obviously, then you get your pro rata share each month. And the total for year 1 is expected to be $4,000 in year 1 cash flow to you. Year 2, $469,000, which we saw that's what the property was planning on doing on our budget, comes out to $4,500 in year 2. Year 3, $684,000, what the property does, but a $100,000 investor can anticipate getting their pro rata share, which is $6,600 plus $5,800 from the refi. Now that's $605 that the property is getting. That comes from this number right here. $605,000 is our proceeds from our refinance. Okay, so that's what this number is here. $605,000, and then it's that same percentage. That 0.97 times 605 is $5,800. Year 3, our cash flow, year 4, our cash flow is going to go up because we've got a lower interest rate loan. And then year 5, same thing, cash flow of $10,000, plus you get your $100,000 back, plus an extra $54,000. That's an overall, so $100,000 partner over those 5 years can expect a total of $195,000 back. So basically, almost doubling your money in 5 years, and that would be a 20% return. So that's $95,000 back on your $100,000 investment. And again, that's with conservative numbers.
Okay, how many buildings are there, and is there a swimming pool? Want me to take that?
Okay.
They count them as 4 different buildings, but that's just because it's built in a rectangle shape. But all of it is underneath one roof, and all of it is built around a center courtyard, as you can see in this picture. So really 4 different buildings, but all under one roof, built around a center courtyard. And all of the, yes, there is patio access as well, but all of the main entrance to all the apartments are inside. So that none of them open to the outside. So that's it's kind of a benefit here. Question is there a swimming pool?
Well, showing you the picture of the pool.
Go ahead.
Let me add something onto that, Brian. It's actually in a figure 8, in a figure 8 style. So this is one of the courtyards, and it has the pool. Then there's another courtyard with a grassy area in the middle of it also, which is a smaller courtyard. And while it's all under one, it's all one building, but there's technically, because of the firewalls, if you count the firewalls, there's 5 sections. So I think that would be a more apt description of how many buildings, because the firewalls would give us 5 sections. And it's in that figure 8 with one courtyard having the pool and the other one having a grassy area.
Okay, said the question is, did I hear correct that closing cost also includes the refinance cost from bridge to agency debt?
No, hold on a second, let me go back to that. What it is we have in our closing costs on our refinance, 2% closing costs. So there's an exit fee of 0.5% that's included in those closing costs. So that's there. And we didn't include, so to answer your question, the closing cost for the exit fee is in our refinance. The 2 points that are being charged by the lender are included in our closing costs here, okay? So, but then we also have that lender reserve of $900,000 that after our negative cash flow, we're anticipating having $750,000. Well, that $750,000, if, ooh, there's a typo. When we do the refi, if there's money needed still, if they still have that in place in 3 years, which I sincerely doubt, a requirement of the lender to put up reserves, then we're going to use that $750,000 from that lender reserve here. But my anticipation is that we're not going to need the $900,000. We're not going to need the $750,000 left out. My anticipation is that is going to be distributed back to the partners, which isn't even included in our numbers. But if I add $750,000, like I said here, plus $750,000, then our returns are 21% per year average. So, I mean, year 3, that $100,000 partner would get $19,000. Follow? And I put it in here in case you wanted to put $300,000 instead of $100,000. You actually get $12,000 in cash flow, $13,000, $19,000, $28,000, and $30,000. So percentages are the same, but the dollar amounts are obviously larger.
Okay, Darwin, can you please explain the financing in more detail? How long is the rate locked on the bridge loan?
It's actually it's not locked. It is a floating rate with a floor of 4.25. Now, before that goes up, interest rates have to go up. I forget how much. Interest rates have to go up another 0.5% before we go up above that floor. But we also, in our closing costs, we are also buying a cap of like 5.25. So we have a cap on that of 5.25 because it is a floating rate.
Okay. If it's 4 floors, does it have an elevator?
Yes, it does. It has a few of them. How many elevators does it have, Ryan?
Well, it has 2 different bays,
Okay.
one on each side.
Okay, good.
They're kind of centered in the middle. Okay, how much is the minimum investment amount?
Minimum investment amount is $100,000. This property, it does have a dog park, and it has something else cool I've never seen on a property. It actually has a coin-operated dog washing station indoors, where you put the gate down, the dog goes in there, it's lifted up about 2 feet. You lift the gate up, and they're in there, and they can be clipped in, and so you can wash your dog in there. Coin-operated, extra revenue. Never seen anything like that. I think they spent $75,000 on that dog washing machine. But that gives you an idea that they spared no expense. It cost them $400,000 to run the dedicated internet line to the property. So they did not skimp. They did a very good job.
Darwin, that's a perfect segue. The next question is, can you speak more about the amenities? So I'll kind of start that, if you don't mind. Lots of amenities at this property. I mean, just no particular order, but Darwin just mentioned the 500 megabytes built-in Wi-Fi that was run, the special fiber line that goes to this property. The property I would consider certainly covered parking as an amenity. It has a dog park, and as Darwin just mentioned, an inside dog wash that will be an income generator as well. It's got a business center. It's got a fitness center. It's got a big office leasing area. So yes, lots of amenities here, and that's not to say anything about the smart controls that are in the units as well.
Yeah, smart controls on the doors. You've also got a conference room, video conference room. You've got 12-foot ceilings on the first floor, 10-foot ceilings on the second, third, and fourth. You've got stainless steel appliances, washer dryer connections in every unit, quartz countertops. You've got a package center. Is it an Amazon package center?
Yes.
I don't remember. It's an Amazon package center. You've got covered parking garages, storage units. Let's see here, dog park. View out of the back, gorgeous views of the golf course. Great views out that side, and around the courtyard with the pool. You've got a pool view on those side. Every unit has a patio. It's gated to get inside of the property. So you don't have gated access for the cars, but you have gated access to get inside of the property with common hallways through. It's also got door-to-door trash pickup, and a mat right outside to hold the trash bags. You put them out there, and those are collected. Every amenity that we could possibly think of, like a dog washing station. I've never seen that. So amenity rich, definitely. That's why we call it an A-plus property.
Okay, Darwin, are you planning to keep the Airbnb units going forward?
Okay, now what we're doing on that, the Airbnb units, count those more as a corporate lease. Those are going to be leased back by Bill, and he's going to have anywhere between 12 and 24 units, depending on his demand right now. I think right now he's planning on 20 to 23 units, and that is a corporate lease. So we are not operating a Airbnb business. He is. He is going to have all the revenue from that, but he's also going to have all the expenses and maintenance, et cetera. So we're doing a corporate lease with him. He's paying market rent on the units that he leases, and that way we have one tenant with about 20 leases, about 20 units, and get one check from him each month for that, because we don't want to be in the Airbnb business, and we don't want that for the sake of lenders, et cetera. It's a headache, and it is a completely separate business, which is why our property in Fredericksburg, we actually hired a management company to run that. So think of it more as a corporate lease with one entity that is leasing 20 units.
Okay, what is the name of the nearby golf course? I believe that is Indian Creek Golf Course.
Yes, it is.
Yep. Question here, who is the seller?
The seller is a partnership put together by Frankford Station, partnership put together by Bill, a guy named Bill Janasek, another guy, Michael Hoffman with Longhorn Capital, and myself. Technically, I'm part of that ownership group, and we put together the private placement memorandum. We helped him raise money, and so we did have this as an offering to our partners, but nobody wanted to be involved in new construction, even though it generated over a 20% per year average return. So in that equation, the sellers is a partnership controlled by Michael Hoffman, which is Longhorn Capital. And since they're hitting their targeted yields that they wanted, and they're doing it a little bit earlier, even with the higher vacancy, then they're saying, okay, yeah, let's sell it, because Michael Hoffman, he's a hard money lender, a very savvy businessman, a great guy. Let me go ahead and do a plug. If you ever need a hard money loan, for example, Michael Hoffman with Longhorn Capital is the one who did that. And those of you who were in Parkside, or not Parkside, in Park Row, if you recall Park Row, a week before closing, our lender pulled out, and I had to get the property closed. And it was a call to Michael Hoffman, who loaned us $5 million, as a conduit through Paul Peebles, who set that up. But Michael, he went ahead and loaned $5 million in a week on Park Row to us. So we've had a long relationship with him, and also looking at doing some more development deals with them.
Okay, are there apartments for handicapped people? The answer is yes. There are actually 5 handicap units that are equipped as such.
That's building code requirements, obviously.
Yep. Okay, getting down to the end here. What determines whether 8 million or 12 million will be raised?
That all depends on the debt. We've got our loan quote at that 31 million and change right now, but we did a larger range on this one because if they come back for some reason, I wanted to have enough cushion. If the lender said, no, not going to loan 31 million, we're only going to loan 28, then we would have to raise another $3 million. And that we will know that number. First and foremost, the term sheet that they gave us has that loan amount, and we haven't had anybody come back later and lower the loan amount. But this is a new lender for us, and I wanted some cushion in there just in case. Again, we always operate with plan A, B, C, D, and E in place anytime we do a deal, because we want to make sure that that we can accomplish our goals and under promise and over deliver. And so we needed to have that cushion there just in case.
Okay, do you have the IRR calculated?
Our internal rate of return, no, I do not. But while we answer the next question, I can go ahead and do that real quick.
Okay. Next question is, if lease up is completed quicker than anticipated, how long would you have to stay in the bank loan?
We can actually do it quicker. So that is a possibility of getting that done faster.
Okay. If the cost of the internet package is $9, how much of a premium, or what is the resident paying basically? And is that income included in the other income?
That is included in the other income, and they are paying, I don't remember the amount they're paying right off the top of my head. Do you know what they're paying?
Yeah, roughly 130 bucks.
Okay.
Yep. Let me move on here. It's like most of these are just repeat questions, but Darwin, can you explain your business plan other than better operations?
Well, the value add is management on this. Obviously, they haven't done enough leasing until now, and just as our management team has proven in between 2019 and 2020 that we operate less expensive and we maximize our income. And a big part of this is that they have not been doing marketing. It's just been poor management is the bottom line. So by us doing the management, there's nothing I can say besides we just do it better. It's a better effort that we put out than other people. It doesn't look right.
Okay. One more question here, Darwin, while we're doing this. It basically, to paraphrase, this is the second deal in a row where you've been able to achieve management prior to ownership. Is that a long-term strategy for DGRE?
I would love to do it every single time. However, it's just an unusual opportunity.
Yep.
Why is that not coming out? Well, it's showing an IRR of about 15% to the partners, which I don't think that is accurate. That's why you shouldn't do things on the fly. So we'll have to get back to you exactly on what that is.
Okay, we'll get back. Okay, I believe we've answered all of the questions here. Let me just a couple of reminders, and while any additional questions may come in. As I said before, this webinar is being recorded and will be sent out to all on Thursday. Look in your email box from us on Thursday. Also want to let everybody know, just a reminder about the road trip this Saturday from 10 a.m. to 12 p.m. We'd love to see you there. And again, we'll send out an invitation tomorrow. If you don't mind, if you plan on attending, please let us know. We just want to kind of prepare for how many people may be showing up. And again, please observe social distance rules. We'll be considerate. Also want to let you know that that if you have an account in IMS, the PPM and all the documentation is live now. So you can log into your IMS account as we speak and go and get all of the info. If you do not have an IMS account or account with us already, please reach out to us and we'll help you get set up or answer any questions that you may have about that. So having said that, I'm going to ask, Julian is out there. Julian's our head of our investor relations department. So Julian, anything you want to add here in regards to the presentation or answer questions or how to get in contact with you?
By the way, before Julian does that, while he's unmuting and such, I just want to make another point real quick. Everyone out there is looking for yield and for future upside. Yields are being killed right now wherever you're investing, and they need future upside. And so I'm asking, who else do you know? And refer them over. Obviously, referrals are the best thank you we can get. But think about, who do you know that's an accredited investor that needs a good return on their money? Because remember, this is a brand new asset without any historical problems. Everything's new: HVAC, plumbing, electric. We won't see any CapEx that needs to be put into the property every year like most of the older properties. So we're looking at a nice, solid return, and there's a lot of people that need that yield. So if you have anybody else that you want to refer over, we would take that as a great, great compliment to us. So thank you so much.
You bet. Darwin, not to get off the subject of Frankfurt, but let's end this on another positive. We have 3 or 4 people who have said, would you please provide a quick update on Villa Creek? So that's a huge positive. So give them an update.
A quick, the buyers have already put up earnest money. It's under contract. They've done their due diligence. They're moving ahead very, very good. They are a local syndicator as well. And we've never done business with them, but they have been very good so far. They've got non-refundable earnest money up, and they're moving ahead. Their loan is moving ahead. They've done everything they said they would do, and no problems that came up during due diligence. And that is scheduled to close late April. But they have a right to extend depending on what their debt does. And if there's a update, I know that I don't know if their lender is online. He might be, and if you want to shoot me a text and let me know how that's going, then that would be great. You know who you are. But yeah, Villa Creek's going great. No problems, moving ahead, nice and solid.
Okay, last question here. Is this eligible for 1031 exchange people?
No, it is not. 1031 exchanges, let's just say you buy a house in your personal name, then you can go through and buy another property. You can sell yours and do a 1031 exchange into another property, but it has to stay in your same name going from one property to the other. And it's the property, not the investor. For example, when you're investing in this, you are investing in ownership entity of the company, just like buying AT&T stock or some other stock. You are an owner of, you own some of the stock in that company. A 1031 exchange, tax deferred exchange, would be if we sold the property and then used all of the proceeds, everybody rolled that over, then we would buy another property in the same exact name, because that has to be the same buyer going from one to the other. So if you sell a house, you can't do it into this unless we had it struck. The only way to do that is if we have this structured as a TIC, tenants in common, which is a lot more confusing. And eventually we will probably be doing some TICs, but those are a little more complex and not as advantageous. One question is, anything else in the pipeline for sophisticated? And yes, we will have something coming out in the near future for sophisticated investors.
Okay. Well, I will close this with no additional questions. And again, just a reminder, we are recording this. It'll go out to everyone. Please join us for the road trip on Saturday. PPM and all information is live in IMS. You can go out there now. If you don't have an account with us, please reach out to us. We'll be glad to help you get that set up and provide all information. And again, thank you for joining us tonight. Darwin, thanks for the great information. We're all excited about it. And we'll go from there. So successful investing to everyone.
All right. Thank you, everybody, for joining us.